This is why silver could surge to $300 by mid-2026, driven by the most severe supply crisis in modern history. Market forces have created what analysts call a perfect storm. Structural deficits, geopolitical restrictions, and explosive industrial demand converging to push silver into uncharted territory. We're witnessing something unprecedented in precious metals markets. After silver's historic 147% gain in 2025, climbing from under $30 to a record high of $100.78, the fundamentals suggest this is just the beginning. Bank of America's head of metals research, Michael Widmer, stated on January 5, 2026, that silver could reach anywhere between $135 and $309. But the question isn't whether silver will hit these targets. It's how quickly it will get there. Let me walk you through the 5 critical factors that make $300 silver not just possible, but probable by summer 2026. Silver is entering its 5th consecutive year of structural deficit in 2026. This isn't a temporary imbalance, it's a fundamental breakdown of the supply-demand equation. According to the Silver Institute, the cumulative deficit from 2021 through 2025 has reached nearly 820 million ounces. That's nearly 750 million ounces of silver that simply doesn't exist to meet demand. But here's where it gets critical. In 2026, the situation becomes catastrophic. The annual deficit is expected to reach approximately 200 million ounces, more than double previous years. This isn't speculation. This is mathematical reality based on known supply constraints and accelerating demand. Consider this. Global mined silver supply in 2025 remained flat at 813 million ounces, while global demand approached 1.2 billion ounces. That's a 400 million ounce shortfall that must come from existing inventories. But those inventories are vanishing. Exchange inventories at the London Bullion Market Association and COMEX have fallen from 290 million ounces at the start of 2024 to below 210 million ounces by October 2025. LBMA's eligible silver stocks have shrunk to just 155 million ounces, while annual demand runs between 900 million to 1.2 billion ounces. These numbers tell the story of a market running on fumes. China's export restrictions took effect January 1st, 2026. This isn't just trade policy. It's economic warfare disguised as resource management. Then China has effectively restricted 60 to 70% of global refined silver supply to domestic use, replacing their previous quota system with a licensing framework that makes silver a strategic material on par with rare earth elements. The immediate market response tells you everything. Physical silver in Shanghai is trading at a premium of over 12% compared to London spot prices. David Stein, CEO of Kuya Silver, reported that Chinese companies contacted him offering $8 to $10 above market price for physical silver. When manufacturers are willing to pay premiums of that magnitude, you know physical supply has become critically scarce. Elon Musk's response on social media was telling. This is not good. Silver is needed in many industrial processes. When the world's most prominent industrialist publicly expresses concern about silver availability, that's not just commentary. That's a warning about supply chain disruption. The restrictions affect 7 to 10% of global silver supply directly, but the psychological impact is far greater. China has essentially telegraphed to the world that silver is now a strategic asset worthy of export controls. This changes everything about how markets price the metal. Industrial demand that's growing exponentially across multiple sectors. This isn't cyclical demand that ebbs and flows with economic conditions. This is structural demand driven by the energy transition and technological revolution. Solar photovoltaic demand jumped over 25% in 2024 to 230 million ounces and could exceed 300 million ounces annually by 2030. According to BMO Capital Markets, solar demand alone will reach 261 million ounces in 2025. That's nearly one-third of annual global production, consumed by just one industry. Electric vehicle demand is accelerating even faster. EVs require 67 to 79% more silver than internal combustion engines, using 25 to 50 grams per vehicle for battery management systems, power electronics, and charging infrastructure. Oxford Economics projects that EVs will overtake traditional vehicles as the primary source of automotive silver demand by 2027, accounting for 59% of the market by 2031. Then there's the AI and data center revolution. Global IT power capacity increased 53 times from 2000 to 2025, as an artificial intelligence is driving unprecedented demand for the high-performance computing infrastructure that silver makes possible. Every server, every data center, every AI chip requires silver for optimal electrical conductivity. Industrial demand already consumes about 60% of annual global silver output, and this percentage is growing. Unlike investment demand, which can fluctuate based on market sentiment, industrial demand is price inelastic. Manufacturers can't simply substitute another material when silver gets expensive. The technology requires silver's unique properties. The breakdown of the paper versus physical market dynamic. For decades, silver prices were largely determined by futures trading on COMEX and London markets. But that system is collapsing under the weight of physical demand. 1-month silver lease rates exploded from typical levels of 0.3 to 0.5% to over 8% by January 2026. In October 2025, these rates briefly spiked to nearly 40%. When market participants are willing to pay 8% annually just to borrow silver for delivery, that's a market-screaming shortage. The lease rate explosion reflects what analysts call extreme scarcity of deliverable silver. The paper markets can create infinite supply through futures contracts, but when those contracts come due for delivery, the physical metal simply isn't there. This disconnect between paper and physical markets is unprecedented in modern precious metals history. An industry analyst captured the situation perfectly. You can manipulate paper prices temporarily. You can't manipulate a physical supply that doesn't exist. Silver's designation as a critical mineral by the US government in November 2025. For the first time, silver appears alongside lithium, cobalt, and rare earth elements as materials deemed essential to US economic and national security. This designation fundamentally changes silver's role in the global economy. It's no longer just a precious metal or industrial commodity. It's a strategic asset. This opens the door for government stockpiling, strategic support for domestic production, and trade policies that prioritize silver access. The designation acknowledges what markets are already pricing in. Silver's essential role in electrical circuits, batteries, solar cells, and antibacterial medical instruments makes it indispensable to modern civilization. Laura Chen, Director of Metals Strategy, summarized the shift. Silver is no longer just a safe haven asset. It's a strategic material for the clean energy transition. From a technical perspective, silver has broken out of a 45-year cup and handle pattern that began in 1980. This generational breakout signals a fundamental shift in the market structure. The gold-to-silver ratio, which peaked at over 105 to 1 in April 2025, has compressed to approximately 57 to 1 by early January 2026. Historically, when this ratio moves below 50 to 1, silver enters what traders call parabolic mode. The ratio has reached as low as 16 to 1 during previous silver bull markets, suggesting significant additional upside if historical patterns repeat. sovereign buyers are entering the silver market for the first time in decades. Russia announced a $535 million three-year precious metals purchasing program led by silver. India has added physical silver to its reserves. Saudi Arabia made its first-ever purchase of the SLVETF. When central banks and sovereign wealth funds begin accumulating silver alongside gold, that's not just diversification. That's recognition of silver's monetary properties. These institutions think in decades, not quarters, and their accumulation suggests they see structural forces that make silver attractive at current prices. So how does silver reach $300 by mid-2026? The mathematics are straightforward. With annual deficits of 200 million ounces and rapidly declining inventories, the physical market faces what analysts call peak tightness, sometime in the second quarter of 2026. And Alan Hibbard from Gold Silver expects silver to outperform its 2025 gains, stating, "I wouldn't be surprised to see the price of silver increase by over $100 per ounce to $175 plus. That gets us to $175. But Hibbard's projection assumes normal market conditions. The convergence of China's export restrictions, critical mineral designation, and industrial demand acceleration creates anything but normal conditions. When physical premiums in Shanghai exceed 12% and lease rates approach 8%, you're looking at a market that's already broken at current prices. Bank of America's $135 to $309 range reflects this reality. The lower end assumes orderly market adjustment to supply constraints. The upper end reflects what happens when paper markets lose credibility and price discovery shifts entirely to physical markets. FX Empire's technical analyst, A.G. Thorson, sees $200 to $300 silver as achievable by decade's end, but accelerated timelines seem increasingly likely given current market dynamics. When physical buyers are offering $10 premiums over spot prices, in January 2026, the spot price itself becomes meaningless. What we're witnessing isn't just a silver rally, it's the beginning of a fundamental repricing of strategic materials. The energy transition requires massive quantities of critical minerals, and silver sits at the center of that transition. Every solar panel, every EV, every data center represents incremental silver demand that won't disappear regardless of price. The supply side offers little relief. Average all-in sustaining costs for silver mining fell to $13 per ounce in the first half of 2025. But new mine development takes years. Even if silver prices incentivize increased production, that supply won't reach markets until well into the next decade. Meanwhile, demand continues accelerating. By 2030, Oxford Economics projects that supply may meet only 62 to 70% of demand, with the solar industry alone requiring 10,000 to 14,000 tons annually, nearly 30 to 41% of current global production. Silver's path to $300 won't be linear. The metal hit an intraday high of $121.67 in late January 2026, only to plunge 35% when Kevin Warsh was nominated as Federal Reserve Chair. This volatility reflects silver's dual nature as both an industrial metal and monetary asset. Some analysts warn that current prices have deviated from fair value, which Bank of America estimates around $60 to $70 per ounce. A UBS notes that rising prices could reduce industrial demand as manufacturers seek alternatives or optimize usage, but these concerns miss the critical point. There are no meaningful substitutes for silver in most industrial applications. Solar panels, EVs, and high-performance electronics require silver's unique combination of electrical conductivity, thermal properties, and corrosion resistance. Price elasticity only applies when alternatives exist. The convergence of supply deficits, geopolitical restrictions, industrial demand acceleration, physical market breakdown, and strategic recognition has created conditions unlike anything in modern precious metals history. Silver's journey to $100 was just the first milestone in what appears to be a multi-year structural bull market. $300 silver by mid-2026 isn't just possible. It may be inevitable. The mathematical reality of 200 million ounce annual deficits, combined with China's export restrictions and exploding industrial demand, creates a supply-demand imbalance that can only be resolved through dramatically higher prices. For investors concerned about currency debasement and economic instability, silver offers something unique: a monetary asset with inelastic industrial demand. While gold remains the ultimate store of value, silver's dual identity positions it to outperform in an environment where both monetary debasement and industrial transformation are accelerating simultaneously. But the question isn't whether silver will reach $300. It's whether you'll recognize the opportunity before the mainstream financial media catches up to what the physical markets already know. In the words of one analyst, silver only goes up from here because the short position is mathematically impossible to close, and real supply is genuinely limited. The silver squeeze of 2026 represents more than a commodity rally. It's a preview of what happens when financial markets encounter the physical limits of a finite world. And for those positioned correctly, it's the opportunity of a generation.